In terms of the equity financing, a debt finance provider will typically only look to provide debt finance if it is safe in the knowledge that equity finance has been provided, either in respect of proportion of the acquisition costs for the portfolio or, and in addition, in respect of ongoing development financing requirements. So for a construction financing project, it is quite common for no bank debt to be able to be invested into the property vehicles until such time as all of the equity finance that needs to be contributed to the construction project has been contributed. In the market now, we are seeing an insurgence of alternative capital providers. Alternative capital providers, which can be hedge funds or credit funds or insurance companies, are competing very strongly with the more typical traditional bank lenders in the real estate finance market. We're also seeing in this late cycle of the property market an increase in mezzanine financing. This means that a real estate portfolio can be quite highly levered, but senior debt is provided, perhaps up to the 65% loan-to-value level, and then mezzanine debt is injected, in the case of a structural subordination, further up the capital structure and with an increased risk profile. In terms of security that a debt finance provider would expect, it is very, very common to see mortgage security. In addition, at the asset level, it would be typical for lenders to require security over insurance proceeds, security over bank accounts, and security over relevant contracts. And relevant contracts would include the sale and purchase agreement pursuant to which the property portfolio has been purchased. In addition, it is normal for share security to be provided over the propco that owns the asset. However, typically this propco may be incorporated in a jurisdiction which is not typically seen as lender-friendly, for example, Italy or Spain. In such a scenario, it is quite common to see a double Luxco structure which sits above the property vehicle. And the reason for this is you then have a company incorporated in Luxembourg, the shares in respect of which the lenders can take security over. The reason for the double Luxco, rather than the JV entity itself simply granting the security, is that at the time of the grant of the security, if you have a special purpose vehicle entity granting the security, then the chances of any challenges to that security are mitigated because it is a special purpose vehicle that is granting the security in the first place. Therefore, the lenders have the benefit of being able to enforce security at the asset level through the mortgage or at the share level through a Luxembourg structure, and Luxembourg is a very creditor-friendly jurisdiction. It is common in real estate financing transactions for the security to be limited recourse. What this means in the case of share security is that the lenders will only have recourse over the entity that has provided the security to the extent of the security actually provided. Therefore, if the SPV Luxco 1 vehicle has granted share security over its shares in SPV Luxco 2, the only recourse of the lenders are to those actual shares. This is advantageous for an investor and for a JV structure because it means that SPV Luxco 1 can then own, for example, SPV Luxco 3 or SPV Luxco 4, which are then completely separate and bankable real estate asset pools. The other advantage of Luxco security, particularly in a multiple asset portfolio context, is it creates a single point of enforcement for the lenders. It is common in a real estate context for a portfolio to be levered with bank debt or alternative capital providers' debt. In this scenario, lenders will typically not wish to lend until they have the assurance that the equity which needs to be invested into the project has been invested, be that by way of the price of acquisition of the assets, or in a construction context, ensuring that the equity provision has been made before a penny of bank debt goes out of the door.